Okay, now the excitement is really building as we come to the financial statements. What you see here is that Viva Financial Tuition has put together a document using the figures from the pre-scene, of course, in the financial statements, but we have added some figures of our own, some ratio analysis and percentage changes and absolute changes as well. It helps us shed a little bit more light on the numbers and what they mean. Starting with the BES Group Consolidated Statement of Profit or Loss for the year. We start with the top line. Revenue is up 11.4%, so that's a healthy rise. We're told a little bit later on by the chairman of the company that revenues are at record levels and so are profits. So that's a positive. And what we see next is that the cost of sales figure is also rising, but slightly lower than revenues, which is a good thing. They've got cost control here, and it leads to a higher gross profit rise of 11.9%. The concern, I would say, lies with the administrative expenses, which have risen 15.1%. It's not huge in absolute terms, just 1.9 million $, which is not going to hugely affect the profit figure, but they do need to keep an eye on that. The operating profit then is up 14.3%, and you'll see at the very end of the profit and loss statement that the net profit figure is up 17.9%. So as we move down through this profit and loss statement, what we see is the percentage increases for the profit figures are rising. So good cost control in general. And one thing I would point out as well is that the finance costs have risen 7%. We'll see in the balance sheet in a minute that this is a firm that's carrying too much debt. It's also a problem for VES, the main rival of BES in country E. Overall, though, this is a company with strong profit margins, good returns on their investments, and they're increasing in 2016. We'll see that further in the ratio analysis very soon. We come next to the Group Consolidated Statement of Financial Position. We have the comparison between 2016 and 2015. And starting with the non-current assets, we have intangibles. I think we're talking mostly here about trademarks, software, etc. We know that IT is a big part of what this company does. The tracking and analysis of data is really very important in getting customers the products that they desire and tracking customer habits and changing habits. And what we notice interestingly is that this is down for the year. We wonder whether intangible assets should be growing given the importance of IT to this company, given the importance maybe of software as well that lies behind the tracking of consumer spending habits, etc. Property, plant and equipment then is up 7.1%. It occupies the greatest percentage of total non-current assets. So they're clearly looking to invest for the future. Current assets then, inventories, we see are up 17.9%. That's quite a steep increase. We know from earlier reading that the company is not sourcing any more than 5% of their supplies from any one supplier. But we do know as well that they are buying in bulk. So that leads me to think that inventories, I'd like to see that growth at a lower level than 17.9%. They want to keep an eye on that and ensure that it's not getting out of control. Trade and other receivables is up by a very small amount. Cash then, it's good to see that grow by a pretty healthy amount of 8.6%. But when you look at that cash figure of 11.4 million, it's not going to do much in the way of being able to invest huge amounts in property, plant and equipment and things like that. It's quite small compared to those non-current asset figures. So total current assets stand at 35.5 million for the year of 2016. Share capital and share premium, then it stayed flat. No new shares being issued, it seems. So they're not financing investments in that way. Retained earnings are up by 9.5 million. We go back to the profit and loss statement and we recognize that they had 42.1 million in net profits. So 9.5 is being retained and 32.6 million, that means, is being paid out either in dividends or being reinvested in the firm. The shareholders may have certain expectations of this firm. Maybe they expect a regular dividend, or on the other hand, maybe they're more interested in the firm reinvesting those profits for the future and thus securing a better share price in the future too. It's a balancing act. When we come to the last two sections of the balance sheet, things are interesting because it's interesting for the very low detail that is revealed. Non-current liabilities, current liabilities, one line each there. They're giving nothing away here. That's the same as well for the VES group. It seems to be an industry practice or standard. And you have to question if the investment community is happy with such a presentation. They're probably going to want to see more detail there. Non-current liabilities, we might assume that we're talking here about long-term loans, but we cannot be 100% sure. If we are talking about long-term loans making up the bulk of that 172.8 million, then we're talking about a firm with a very high level of gearing, which is actually suggested by the profit and loss statement. We saw that the finance costs are rising for the year, and I think this is a very highly indebted firm, which is introducing risk, and it doesn't give them much scope in terms of future investments. How are they going to fund them? They're not going to be able to take on more debt without introducing too much risk to the company. Current liabilities then, I mean, are we talking about trade payables here or something else? Short-term loans perhaps? It's impossible to say with the level of detail that is hidden and wrapped up in this current liabilities figure. One line again, 59.4 million. What I would say is that comparing that with the current asset figure, obviously it's exceeding the current asset figure, which indicates to me that this is a firm with liquidity issues. Okay, we'll see that in more detail when we look at the ratio analysis. So let's take a look at the ratios for the BES group. Looking first at the profitability ratios, and what we see is that this firm has solid margins. Okay, gross profit margins, operating profit margins, net profit margins are all very solid. 37.1%, 15.2%, and 9.5% respectively. And also it's good news that those margins are improving compared to 2015. The return figures then on the capital employed, you might remember, is the sum of equity and non-current liabilities. So those investments are giving pretty solid returns as well. 15.7% return on capital employed, which is taking the operating profit figure over the capital employed figure. And then the return on assets figures and the return on equity figures are also demonstrating the numbers are going in the right direction. So this is a company that's investing well. It's getting a return on those investments. Liquidity is where things start to get a little bit concerning. I mentioned that the current liabilities figure is exceeding the current asset figure, which is not really what you want to see. The current ratio, which is simply the current assets over the current liabilities, is flat for the year, 0.6. Ideally, you want to see that in excess, certainly, of 1 and possibly even higher. And when you strip out inventories, which is what you do for the quick ratio, which is the next figure down, you've got even lower, an even lower ratio of 0.4. So that is certainly concerning. They want to be looking to maybe build up their cash position, and whatever they have in current liabilities, maybe it's payables. The payables figure might be too high, and maybe they need to be paying their suppliers a little bit earlier or something like that. Maybe there's a short-term loan in there as well, and they need to look into alternative means of financing and pay down some of that debt. It's difficult to say given the lack of detail on the statement of financial position.